So next 45 minutes, it's all about markets. It's all about, where we're headed. We'll talk about both long-term and short-term here. And, whereas the MC has done a great job of introducing some of my panel members, Bharat Bhai needs no introduction. When I started my career 20 years ago, I was being told he's a legend, and he still remains like that. He's a legend when it comes to investing. Now, the lady on my left, markets like to call her Amisha Bhen. I would just like to call her Amisha. That's okay with you. Can I just call you Amisha? Okay, wonderful. Well, the three fund managers now, two of them were very old friends, but when brokers, they become fund managers, we'll get a different perspective, I'm sure. You've started looking at markets differently ever since you become fund managers, right? Okay, so we'll have some fun conversation. So, Vikas, I'm going to start this with you. And if you have to describe the market where we are headed for next 1 year, how would you describe that? But before you answer that, I'm not allowing you to use the word volatility.
So I think we are in a very interesting phase. I think, we had a fairly, turbulent and volatile period. So I'm explaining the past so I can use it. We had a very bad market over the last 3-4 months, especially one of the worst September we have ever had. And I think, all factors put together, both global and local, came and hit markets. Especially in India, we had ILFS and all the local issues hitting us. But I think 2 days ago, especially when the statement from Fed, in my opinion, has kind of changed the course of the market, especially in my opinion for 19. I think it clearly indicates most of the issues which we had locally, whether it was ILFS, liquidity on NBFCs, or around rupee, it seems to be calming down. Most of the effect is behind. We had over-leveraged market, which is kind of more or less behind us. So most of the local issues are settling down. Election is ahead of us, but that I think we will have clarity soon. But more importantly, globally, I think now we will have slightly more comfortable environment. A dovish Fed, I think, gives a lot more room to RBI, as Adrian was saying. And I think a moderate global growth, in my opinion. I mean, this statement, according to me, means growth globally is kind of moderating. It is not as it was before. And this clearly indicates that a moderate growth is very good for India. Moderate global growth. Recession is not good for India, but moderate global growth is good for India. We have soft commodity prices, which works for well. Soft oil prices, which works very well for India. So I think this allows us, and I believe that whatever trade war going on, in some sense, helps Indian markets on manufacturing side. We have seen increase in the activity ever since the trade war has begun, pick up on the manufacturing side. So I think a moderate global growth environment is very good for India. So I think the way I see from here, from now to May, we will have some bit of local uncertainty, especially on a political front. But that also, by and large, in my opinion, would be behind. I see reasonably good 19 as compared to what we saw in 18. Earnings are, not bad. I mean, they are much definitely disappointed on what was expected. But I think given whatever happened in September, it was almost similar to what happened in August 15. So I think, earnings would not, in my opinion, disappoint in a big way in 19. And I remain quite positive. I think from whatever portfolio we build from now to, let's say, March, April, probably would be of a similar vintage of what we saw in 13, 14 kind of period. And that, in investing, one thing is very important, that what kind of portfolio vintage you have, when do you do your investments, that also determines your return ratio. So I see reasonably good tailwind for Indian markets, in emerging market in general, but tailwind for Indian market for sure. And once the political uncertainties are over, I think we will probably resume our good investment markets.
Saurabh, in the month of October, if I had to describe the market mood, we were using words like rout in emerging market currency, a vertical climb in crude, a gut-wrenching fall and adjustment in other emerging market currencies. The narrative has changed. Why do you think in a matter of 3 months, we've seen a lot of chop and churn and twist and turns? We are looking at global trades getting corrected. We are looking at crowded trades reversing. Why is there so much of unevenness in front of us?
I think, Nikunj, it'll be helpful if we step back and look at the bigger picture for EM and DM, rather than getting lost in the month to month, because as you're describing, the month to month is extremely uncertain. What is relatively clear is, since the end of QE around a year ago, The US 10-year bond yield, by and large, is heading up. It was 1.6% a couple of years ago. It's, I think, closer to 3.1% now. And to the extent the Fed is not going to bring QE back, I think the cost of capital globally. Remember, the American 10-year bond yield is the world's risk-free rate. And the world's risk-free rate bottomed out around 18 months ago. And as the American 10-year bond yield heads up, the American economy normalizes, whether the Fed hikes or doesn't hike, we are in a world where super cheap money that characterized the last 10 years is gone. If you take super cheap money out of the picture, then risk assets, whether they be cryptocurrencies, whether they be oil, emerging market equities, developed market equities, I think risk assets have a far tougher climb over the next 10 years than they did over the last 10 years. In a world with free money, risk assets, and cryptocurrency was the classic exemplification of it, went to levels which were just beyond any rational explanation. In a world where money means something, cost of money, cost of capital rises, I think we're in a far more measured risk climate. Now that doesn't mean necessarily bad news for our country, especially since the oil dynamic, as Edwin explained quite nicely, the oil dynamics is favorable for us. But I think what it does mean is we go back to sort of classical investing precepts. Buy great companies, sit tight, make money from them. It's worked well in India over the last 10, 15 years. I think people like Bharat Bhai's career, in a way, is a demonstration of how classically high-quality investing makes you tons of money in this country. There's almost no need to go out and speculate. If you buy great compounders, you make tons of money. I think that mode of investing will serve us well, even over the next 2-3 years. If someone had to be more opportunistic and say, hey, I'm not just satisfied buying companies that give me 10x in 10 years and 100x in 20 years, I want to shoot the lights out. If you want to be more adventurous, then I think 2 or 3 themes worth looking at is, I think well-funded banks clearly will do well. I think the NBFC boom really is past us. Most of the NBFCs are well run, they'll pull through, but clearly there are, I would say, a good third of NBFCs who are in serious trouble, and I think will stay in trouble over the next couple of years. So well-funded banks, I think, will be a good theme to focus on. I think our pharma sector has been pounded beyond belief. I think there's a long overdue recovery that I think Indian pharma will go through. And the third theme, I think Vikas mentioned it, and I think it'll come back again and again, is I think Indian manufacturing, long in the shadows, Indian manufacturing will have a recovery as the RBI data is clearly showing that capacity utilization in the economy is hitting 75-80%. So our manufacturing sector, our capital goods sector, has a long overdue recovery ahead of us. But leaving the opportunistic themes aside, classically high quality investing has worked before, I think will work, especially as globally the cost of capital normalizes after an exceptional 10 years of super cheap money.
Amrit, I'll take the liberty of just quoting, some global market callers. We had an extraordinary pleasure of interacting with Ray Dalio a month ago on the channel. Then we had Howard Marks. The sense which I'm getting from some of these so-called global gurus is they are essentially indicating that the US economy is on a sugar rush, and next year will be a tough year. There is no cynicism in the world, and after a 10-year bull run in the US market, the world should watch out for some mean reversion. Put that in context for us, what it means for Indian investors. Because when you hear some of the billionaire successful investors calling for not a red light but a yellow light, you just tend to ask yourself, am I missing on something?
So talked about Ray Dalio, I just like the 3 words that he says, pain plus reflection equal to progress. So just to reflect back and taking from where Saurabh left, last 10 years, if the genesis of global financial crisis was excessive leverage, that leverage has not gone anywhere. It just shifted from private balance sheet to the public balance sheet. The large central banks in the world have gone from $4 trillion of balance sheet to $15.5 trillion of balance sheet. And now, of course, that's getting unwound. So starting from US Fed and then ECB from December onwards, and some of the other central banks are likely to do that. Global debt as a percentage of GDP today is higher than where it was in 2007 and 8. And today the amount of debt which is required for $1 of additional growth is much higher than what it used to be 10, 20, 30 years ago. So we are definitely, for us to grow at the rate at which we have got used to from a global perspective, I think is going to be a lot more tougher and tougher. Now this whole money printing historically, I mean, as the classic theory, should have led to inflation. It didn't lead to inflation in the goods and services, but it led to asset price inflation. And that's why the asset, I mean, we have seen the asset prices inflated. He talked about like right from cryptocurrency to real estate to stock prices. But it also contained volatility to a large extent because you had this unwritten put option from all of these central banks. That put option is now taken back, notwithstanding what Powell said yesterday or day before, and markets have gone up. But I think we should be less and less reliant on what the central banks have done. They have been the only game in town. They won't be the only game in town going forward. And that's why, though you told Vikas at the beginning that don't use the word volatility, but I think that's a beast we have to learn to live with. I think what we saw in 2007, where we did not have a single month of drawdown in Indian equities, that was something exceptional. That wasn't the normal. We are getting to a more normalized market where we'll see probably a substantially higher volatility than what we saw in 2017. We have seen that in 18, but unlikely to change that in 19 as well. So, I mean, if the global economy, I mean, if the global markets are going to see more volatility, I think we will also see. The heartening feature from India's perspective is, I think, the rise of the domestic savings coming into the equity market. And despite the volatility over the last 10 months, I think we are seeing a huge resilience among the retail investors, domestic investors, and you add that with the money that's coming from the pension funds.
Would you like to thank media once?
Sorry?
That we played a large role in
of
keeping
course,
this
and particularly Nikunj, you wanted your name.
No. I just
on a
wanted
very
a
serious
grateful
note.
admission that media sometimes plays
on a very, I mean, we have been associated with you. On a very serious note, I think it's a joint effort by the media and industry and advisors, I mean, people who are sitting here. I think the awareness that has got created will keep us relatively in good stead if something goes really wrong with the rest of the world in terms of, I think if this domestic flow of like more than $1 billion in SIP, you add few $100 million from the EPFO and the pension funds, I think that will really help us. But otherwise, I agree with them that at the end of the day, you need the corporate profits to grow. Corporate profits actually have come down as percentage of GDP, which everybody talks about over the last several quarters. Corporate savings as a percentage of GDP have gone up in last few years, actually, which means that there's good, I mean, the amortization, depreciation as a percentage has gone up quite a bit. At some point in time, that money is likely to get spent. I mean, we have been in this huge deleveraging process that seems to be coming to an end. At some point in time, we are going to see a reversal in the corporate capex. So an economy which has been firing mainly on one cylinder, which is consumption and a little bit from government expenditure, will start seeing a little bit fire from the corporate capex. Maybe a quarter or two when people have a little more clarity on the economy, when let's say the capacity utilization goes up a little bit. I think and the corporate lenders, as we talked about, are in a better shape to take a little more risk. I think we'll see that revival going forward.
You know, while you praised media, my producer was smart. He said, "Sir, we've taken it live because Mr. Manoj rarely praises media." Okay. Now the lights have gone up, which means the spotlight is on Bharat Bhai. Bharat Bhai, the way you've invested over the years is that you've believed in buying good businesses at a good price and then you hold them irrespective of macros. You bought IT, pharma, and some great classic compounders, autos. The way you invest right now, you think there is enough and more opportunity available because some of these classic businesses are not exactly available, are available cheap. So how are you hunting in this kind of market where the definition of quality has been overpriced?
Nothing really changes in investing over time. It's just that our minds are fickle and we tend to find some newness of a meaning at a particular point of time. Otherwise, the essential principles remain the same, essential ideas remain the same. You don't say that this time I'll do quality investing, but at some other time I'll do something else. And at third time I'll try to find out some other way of approaching. The path to good investing, in my opinion, is a very narrow one. It is a very narrow kind of a path where you have to hold yourself carefully and walk through that path. There is not too much scope for deviating left and right unless you want to injure yourself or you want to hurt yourself. So I really do not, many times I find that over analytics and breadless kind of analytics of many general factors what importance does it really have for investing? Ultimately, all the vagueness and imponderables of so many global factors and other factors that we talk about matter little so long as you bought a good business at a sensible price, which is run by quality people and which is going to enjoy quality long-term growth. If that task you have done carefully, then all the noise about Fed or oil or this or that is really one of the most mystifying factors of the market, which I have never got around even after 30 years of investing, is the great tendency of even professional managers and investors to delve so much into the imponderables and generalities rather than dirtying the hands into the specificities of the individual stocks. And that, to my mind, is the only meaningful way of investing over a period of time. If you are, if macros matter so much to you, then probably you will be delving into the short run and trying to find new meaning every twist and turn of the time. But if you are invested into the businesses, then it perforce will make you think about the long-term nuances of that business rather than getting lost into the generalities.
Okay, so before I go to Amisha, just a follow-up question. You've always said that, look, when I invest, I don't look at macros. But when you see interest rates moving higher, which act like gravity, when you see crude prices turning volatile, when currency goes up 10%, these will impact businesses and the basic durability and their competitiveness.
No, it doesn't. It is only, it impacts our mind rather than anything on the businesses. Take any number of businesses. I mean, take for example a company like Pidilite or a company like Asian Paints, which will be impacted negatively when oil prices are high. And obviously they have a greater strength when the oil prices are low because bulk of the raw materials are oil-based derivatives. But look at the kind of value creation over a period of time. Do you think oil prices have gone up only recently and fallen only recently? Oil prices go through the cycles like so many other cycles. Our minds go through cycles all the time. And oil prices go through the cycles. But good companies, good businesses, they know how to take into account all of these, manage it, and eventually build a high-quality business which is going to stand the test of time. You talk about interest rates. When have you seen that interest rate cycle is for the first time in the life? Interest rate cycles have happened hundreds of times. Over the last 20 years, at least I have witnessed minimum of 4 significant interest rate cycles. So what has happened? Quality businesses, good firms, good businesses still have grown through all of that and have managed themselves. When have you not seen over a long period of time rupee not depreciating, except in the 4.5 years it held on and appreciated a bit before the recent oil and other factors probably caused some rupee depreciation. But otherwise, that has always happened. So has it changed anything about finding good businesses? Unfortunately, instead of doing hard and specific work of finding specific factors relating to the business, we delve into too much of generalities and too much of kind of vague imponderables. I think if your mind is focused and you delve into that specificity, that doesn't insure you against day-to-day fluctuations or periodic cycles. But over a period of time, through the cycles, if your understanding and evaluation is right, you will be all right.
Yeah. Whereas the endeavor is to always find good businesses. Where are good businesses? How would you view risk versus reward for the audience and back home our viewers? For someone who's thinking, how should I understand macro? How should I weigh in political risk? There's a general election coming in next year. How would you connect the dots for investors right now?
So I think there are a couple of things which are very critical. One is what is happening around in terms of all the noise and all the events. But one thing is happening is that India is getting a lot of protectionism, lot of, whether in terms of minimum economic price or ADD or now import duty, which all supports domestic manufacturing. What is also happening is we are coming out of a very long period of a large part of our lending system being crippled or paralyzed and not getting sufficient velocity of money in the system. Having these two factors and the fact that we are largely a domestic consumption-oriented economy, I think we are very safe in terms of the basic growth in the economy and the expansion in our economy. And now with rate cycle also looking pretty benign, I think once again the interest and the growth will be back into domestic, discretionary and non-discretionary consumption, which has been faltered for a while in past 1 year. And I think corporate-facing bank, which has gone through a huge pain, and now with very determined effort, there is the NCLT happening, which has brought a lot of logic back into lending. I think these two areas, that is capital goods, corporate-facing banks, and discretionary consumption is the place to find good businesses. And I think one argument will always remain, are we finding good businesses at right valuation? But the way flows are, whether domestic flows, whether global flows after last year's negative flows and the expected positive flows next year, I don't think we are going to get good businesses at a very throwaway price, except for a very small time when some panic happens. So we will have to learn to take good businesses at good prices, or rather uncomfortable prices, so to say.
Okay, Vikas, you are in the process of raising money. Assuming that you would be looking at starting your investment for your clients very soon, how would you be investing with an event risk, with volatility which is back? We are not exactly in a throwaway range in terms of valuations. So there is an opportunity and there is a risk. Where are you, smelling things? Where are you spotting gains?
I think that Nikunj will always remain in any kind of market. That whether any kind of market, there would be risk and there will be reward. As I said, that I do see next 3 to 6 months, if the market environment remains like this, a great investment opportunities. And India is one of the market where you have lots of ideas. If you ask me the kind of width you have in the market, we have lots of macro trends, and within that you have to obviously find out great ideas. Corporate sector bank, which we have recently come out with a huge amount of pain, I think at least some of the larger ones offers a very good risk reward from a long-term sustainability perspective. I don't think that sector is going away. Manufacturing is again, there's a huge tailwind ahead of you, behind the sector, and I think that can create huge amount of value. Consumption will always remain that. But in my opinion, I completely agree. Whatever the market, you have to think about all those things. But at the same time, it boils down to finding good business. As Bharat was saying, that it boils down to finding good business models. It boils down to finding right managers. You might have a great industry tailwind. We have seen, in a great banking tailwind, a lot of banks did not participate. In NBFC tailwind, a lot of NBFCs did not participate. So I think ultimately it boils down to, even if you found the right trend or right segment or sector, it boils down to finding the right management team, right where you can back. And obviously, if you are looking to invest from a long-term perspective, I feel that it is hard to go wrong. I mean, you have to really work hard.
Did you buy Edelweiss in the new fund? Did you buy the stock of
Look,
Edelweiss?
I can't comment on the stock specific, but I can only tell you it's a great company. It is one of those management teams which I think will create, it has created a significant value in the past, and it will create over the next 10 years, in my opinion, only right sector and great management team. I have no additional insights, and what I will do, I can't tell you, but in general, I am making comment with all disclaimers. But again, coming back to the point, I think there's huge width, in consumption, in investment, in manufacturing, and you can, and across caps, you can do large caps, mid caps. So I remain very, very positive, from a wealth creation perspective over 10 years. And it does not matter what kind of, macro at this point in time, as Bharat Bhai was saying. Of course, we have seen all kind of macro. It will again come back. We will again see buoyancy. We will again see, euphoria. We'll again see pessimism. So ye hoga. But in all these things, you have to find your sustainable wealth creators. And if you take 5-10 years view, I think India will not disappoint you.